Do you remember early 2021? A struggling video game store, mostly forgotten, empty malls, and then suddenly, chaos. GameStop, a stock sitting quietly around $20, suddenly rockets past $400 in a matter of days. People everywhere are glued to their screens. Reddit is exploding with memes, rocket emojis, and talk of diamond hands. YouTubers are yelling, "Hold the line." News headlines are screaming that hedge funds are losing billions. And Wall Street is completely blindsided. This wasn't just a price jump. It was a full-blown financial war. So here's the real question. How did some of the most powerful hedge funds in the world end up fighting for survival against everyday traders on the internet? The answer is one of the riskiest strategies in the stock market: short selling. Today, we're breaking down what short selling really is, how it can make fortunes or wipe them out completely, why it's so controversial, and how the GameStop saga exposed just how dangerous it can be. Quick disclaimer before we go any further. This is not financial advice. All right, let's start simple. Most people understand investing as buy low, sell high. You buy a stock, it goes up, you sell it, you make money. Short selling flips that idea upside down. Instead of betting a stock will go up, you're betting it's about to fall. Here's an easy way to think about it. Imagine a brand new gaming console everyone is obsessed with. You think the hype won't last. You believe the price is about to crash. You don't own one, so you borrow a console from a friend and promise to return it later. You immediately sell it for $500. A week later, demand disappears. The price drops to $200. You buy the same console for $200, give it back to your friend, and keep the $300 difference. That's short selling. You profit when the price falls. But now flip the scenario. Instead of crashing, the console doubles in price to $1,000. You still owe your friend a console. Suddenly, that $300 profit turns into a $500 loss. And if the price keeps climbing, your losses keep growing. That's the danger. Now let's translate this into stocks. First, you borrow shares from your broker. You don't own them. You're borrowing them temporarily. Next, you sell those shares at the current market price. Then you wait and hope the stock drops. If it does, great. But if it rises, your losses start stacking up fast. To close the position, you must buy back the same number of shares and return them to the broker. And here's an important detail. Borrowing shares usually requires a margin account. You're charged interest while the position stays open. Hold it too long, and those costs quietly pile up. Timing matters. A lot. With normal investing, the worst-case scenario is simple. The stock goes to zero, and you lose what you put in. Painful, but capped. With short selling, there is no cap. A stock can only fall to zero, but it can rise forever. Which brings us to something called a short squeeze. This is exactly what happened with GameStop. Hedge funds were massively short GameStop, so massively that more shares were shorted than actually existed. Over 140% of available stock. When the price started rising even slightly, short sellers panicked. Why? Because rising prices mean rising losses. To limit damage, they had to buy back shares. But when short sellers rush to buy at the same time, that buying pressure pushes the price even higher, which forces even more short sellers to buy. It becomes a vicious loop. That's a short squeeze. And during the GameStop frenzy, this squeeze sent the stock from around $17 in early January to an intraday high near $483 just weeks later. The damage was immediate. One major hedge fund lost over $6.8 billion in a single month, wiping out more than half of its portfolio. Another well-known short-selling firm announced it would stop publishing short reports altogether after getting burned. On the other side of this battle was a retail trader streaming from his basement. Online, people knew him as Roaring Kitty. For over a year, he posted deep research, spreadsheets, and videos explaining why he believed GameStop was undervalued. He invested his own money and held through extreme volatility. His conviction inspired thousands of everyday traders to buy and hold. Later, he testified before Congress, explaining he never intended to manipulate the market. He simply believed in the company. So why did GameStop go parabolic? Because it was one of the most heavily shorted stocks in the market. When retail traders bought and refused to sell, short sellers had nowhere to go. They were forced to buy shares at higher and higher prices just to survive. Now let's talk ethics. Short sellers are some of the most controversial figures on Wall Street. Critics say they profit from failure. They root for layoffs, bankruptcies, and bad news. Some even accuse them of spreading fear to push prices down. From this angle, they look like villains. But there's another side. Short sellers have exposed massive frauds. They raised early alarms on companies like Enron, Lehman Brothers, and Theranos. In those cases, they helped protect everyday investors from catastrophic losses. So which are they? Heartless opportunists or necessary watchdogs? The truth is, they exist in a gray area. Here's the real takeaway. Short selling is not for beginners. It's high risk, emotionally brutal, and unforgiving. The GameStop saga proved that markets are not just about numbers. They're about psychology, crowd behavior, and timing. And the next time you see a stock explode or collapse overnight, remember this. There's usually a lot more happening behind the scenes than simple buying and selling. If you found this breakdown helpful, support the channel by liking the video and subscribing for more clear, no-nonsense explanations like this. Thanks for watching. I'll see you next time.